Hi everyone, this is our online lecture for money and the banking system. Let's take a look at what is the learning objectives for this lecture. We're supposed to explain the function of money, okay, and we're going to look at what are various measures of money supply in Singapore, and we'll look at how money is created, and then you have to learn how to calculate that creation using the money multiplier. Now, what's money? Money is any asset that's universally accepted as a medium of exchange. So sellers accept it for payment because sellers are selling goods and services, right? So they accept it for payment, and creditors accept it as payments for debts, right? So we buy something, we pay, and that thing we used to pay it with, that is defined as money. Now, money has officially four functions. The first is a medium of exchange, like we have just talked about, okay? And second is a unit of account, store of value, and standard of deferred payment. Let's take a look at what they are in detail. So when we look at money as a medium of exchange, it's a form of payment for goods and services. Right? When you buy something, we pay money. When you sell something, you accept money for your goods and services. Now, without money, it's going to be quite troublesome for all of us, right? You have to exchange for goods and services directly, which we call barter trade. Okay, that means someone wants good A and is selling good B. So you want to buy good B, you must give that seller good A. Okay, so that's very, very troublesome, especially when either of the good is perishable. So money help us to cut away all that. Okay, so when we want to buy good B, we just buy from the seller, pay the seller directly, and that seller, if they want good A, they buy on their own. Okay, so it's not so troublesome. Now, money have existed in various forms. In the very early history, it existed in the forms of precious metals, okay, and then in primarily gold and silver. Okay, so money is now our notes and coins, okay, but once they came from this type. All right. The thing about money is that it must be convenient for us to carry. Then it serves its purpose. Yeah. So we have moved away from using actual precious metals to serve as money because they are very heavy, okay, and not very mobile. Money as a unit of account. Now, how we measure the temperature with Celsius? Okay, we measure value with money. Okay, then we know whether something is cheap or expensive. Yeah, so it serves as a unit of account. It measures value, right? So we know something is worth how much to us. So money fulfills that. In the same way as we measure distance by kilometers, we know how far or how near a particular distance is, right? So money measures value for us, and we can compare the values of many different goods and services, which are all measured the same way. Money also serves as a store of value. Okay, if you have $2 note with you, tomorrow you can still buy $2 worth of things. Now just take note, if the price of goods and services goes up very quickly in a short period of time, the ability of money to function as a store of value will be very much affected. Okay, now inflation, of course, happened gradually over time. Yeah, so the $2 in my time when I was at your age is different from the $2 is to you now, right? So inflation happens over time, but if within a very short period of time, prices go up very, very quickly, money will have a problem storing value. Okay, so the store of value as part of function of money is dependent that inflation is reasonable. All right, it doesn't go up too fast. Now, how fast is fast that we're talking about here? We're talking about hyperinflation, like millions of percent. Okay, then money will lose its function as a store of value. But otherwise, in a stable inflationary period, money can still largely function, okay, in storing value for future payments. Which is why money also serves as a standard for deferred payment. So when you take a loan, all right, they want you to pay back in money, not anything of that time. All right, they don't ask you to pay back in gold or pay back in silver, right? You still use money to pay back whatever that you owe in the form of installments, because money can store value. Yeah, so that's why we use money as a standard for paying back installments, right, to our loans. So it serves as a standard of deferred payment. Now, so what is the money supply in an economy? It's the total stock of money in the economy at any point of time. Now, let's take a look at what this total stock of money consists of. Now, in any classification of money supply, this M system is used. Okay, so we're looking at Singapore system, which is largely the same as other countries. Okay, so most countries use the same M system to define their money supply, with a little bit of variation across different countries, but it's largely the same. Okay, now we classify the M by numbers: M1, M2, and M3. The smaller the M's, the likely hood that we will use it to pay for something. So M1, the 1 is the smallest number, all right, it's the closest to us. So it consists of demand deposit, which is checking accounts, plus currency in active circulation. Currency in active circulation means the notes and coins that you have with you, right? You pay somebody, somebody accept it for payment, then that somebody use it to pay somebody, so it gets circulated around. Okay, demand deposit are checks that we use to make payments as well. So demand deposit is also known as current accounts, especially in our term. Okay. Now M2 consists of M1 plus quasi money. Quasi means half real, half not real. Okay. So what is quasi? Quasi money refers to all the various deposits that are available in the bank. Okay, savings deposit, fixed deposit, NCDs, we'll explain that in a short while, and other deposits with commercial banks. Okay, now at M2, all right, it consists of M1, that means the one closest to us, plus all this quasi money, which are actually accounts held at the banks. Okay, now why we put it as M2 is a little bit further from us. We don't use it usually directly to make payments, especially like you look at fixed deposit. Okay, the term is fixed, so people don't usually use fixed deposit to pay for something, but wait until it matures, then maybe use the money for something else. Okay, so as the M number become bigger, the additional components become harder to use, or there are more restrictions to use them to exchange for goods and services. All right. M1 is the one that we can directly use to exchange for goods and services. Okay. Now when we go to M3 is M2 plus this additional item called net deposits with non-bank financial institutions. Now this item is the furthest away from us that we count as money. Okay. Now if this exists in the form of perhaps insurance accounts, all right, where you have to wait for a long time before your policy matures, or you have to undergo some procedure before you can extract the value out to use as money to pay for goods and services. All right, so you see where we are going. As the M number becomes bigger, the additional components become further and further away from us. We can still use that component to pay for things, but we have to wait, we have to go through certain processes, or there are some restrictions that we're to live with. Okay, the one that's closest to us, M1, is the one that we use almost without restriction. Okay, so in general, that's how they classify different money items in the M system that comprises of all money supply. Next thing we're going to talk about is certificate of deposits, the NCDs, that we were talking about earlier. Now, if you need to make a large payment in cash, usually our notes, the denomination, the largest is 1,000, and that is hard to come by nowadays. So it's very troublesome to go and amass like a lot of $100 or $50 notes to go and pay people if it's a very large amount. So what people do is that they go to the bank and then ask for a special note, okay, like this certificate of deposit that carries that large amount. So it's like a special note for that one-time payment. Okay, but you can imagine that with electronic banking nowadays so prevalent, this form of using money is getting less and less frequent. Okay, let's look at Singapore's money supply in general, like what we've talked about. Okay, so M1 is the one that's closest to us. Okay, when we use money in this way to pay for goods and services closest to us. Okay, and the definition becomes bigger and bigger. Okay, wider and wider. M2 and then M3. Okay, M3 is the largest, broadest definition of money. Okay, when we say general supply of money, we use M3. Okay, the most narrow definition is M1 that people like you and me use the most often. Okay. Okay, this shows the components of money supply and their values. Okay, you can see what is the current value as in 2018. Okay, so you see that currency in active circulation not so much. Okay, and then it can become bigger in terms of demand deposits, and then savings and other deposit this amount, and then fixed D this amount, and then other deposit this amount. Okay, you can see that the cash amount that we are circulating in the economy is actually not so large. Okay, the accounts are actually financing a lot in terms of our money supply. Okay, and you can see that there's actually not a lot of net deposits with non-bank financial institutions either. Okay, the chunk of money supply lies with all the accounts, okay, under quasi money. Now, we want to introduce an organization that's part of the government that monitors the money supply, and that is the central bank. Now, the central bank oversees all the monetary and financial transactions in the economy. So it's a very important and powerful organization as part of the government. Now, one interesting thing is that we call it central bank as function, okay? But in every country, it is seldom known as central bank. For example, in Singapore, it is known as the Monetary Authority of Singapore. Okay, go ahead and check out what is the name of the central bank in your project country, okay, for your group project. Now, in Singapore's and indeed many different countries' banking structure, central bank is the institution, the government organization that oversees all the financial institutions and commercial banks. Okay, they report to the central bank. Central bank make rules and regulate the entire that part of the economy. All right, and individuals and corporations, okay, do businesses with financial institutions and commercial banks. All right, so central bank directly and indirectly control a large part of the economy. Now you can go and take a look at MAS website, okay, to see what they do and see whether you're interested to work with them when you enter the job market. Okay, let's take a look at the money creation process. In this part of the topic, you need to know how money is created. Okay, now on the onset, please remember, money is created by bank lending. Okay, it's not just printing money and then money is created. Okay, money as a value is created by bank lending, and there's a process, and it can be calculated. Now, this is Singapore's currency house in Pasir Panjang. This is where all your notes are printed and stored. Okay, but money is not created here. Where's money created? Money is created by commercial banks like this. Okay, there's many commercial banks in Singapore, and every time they lend out money, money is created. Let's take a look at what is the process. That system is called fractional reserve banking. Now that means that the commercial banks like your POSB, DBS, OCBC, they don't hold on to all the deposits that you place with them. Now they cannot magically create more money from nothing. Okay, they can only make money when they lend out. Okay, when they lend out, they charge an interest. Okay, that's how they make money. They can have that extra to give you interest rate when you deposit money with them. Otherwise, if they just keep your deposit, it will never grow. Okay, so banks make money by lending out, and when they lend out, they create money. Okay, now of course, when the banks lend out, they charge interest rate, they earn something. Maybe the banks would want to lend out as much as they can, Now, the central bank will not allow them to do that. Okay, just in case customers want to go there and withdraw their money, all right, they need to be able to give back that money to the customer. Okay, if commercial banks cannot give back whatever deposits that the customer has placed back to them, then people will no longer have confidence in the banking system. Okay, so the central bank, the government, cannot allow commercial banks to just lend out everything. They would mandate that commercial banks must keep a certain amount of that deposits in cash with them, so that in case customer come and want to withdraw their deposit, they have the cash to do so. Okay, and that is known as a required reserve ratio that is set by the central bank. Okay, the central bank will say, okay, all the banks, you keep a certain ratio of the deposits that you have, just in case you have customer who wants to withdraw money. Okay, now of course you don't anticipate that all the customer will turn up one day and then withdraw everything. No, okay, it's based on some kind of estimates. Okay, so this is known as the required reserve ratio. All the banks operating in the economy must fulfill this ratio that's set by the central bank, because the central bank is the government. Okay, so you keep that specific amount, okay, in your vault, and you cannot lend it out. Okay, just in case there's people turn up to want to withdraw their deposits. Okay, so this is known as the required reserve ratio. Now, some banks are more conservative. They want to portray as well an image that they are very safe and secure. So they may hold excess reserve. That means they may hold extra cash on top of what the government says they should. All right. So they are holding to a required reserves plus excess reserves. Okay. So their actual reserve that they hold is more than the required reserve that's stipulated by the central bank. So the central bank maybe say that, oh, you must keep 10% of deposit with you. So this very safe bank may want to keep 15%, keep additional 5% more. That additional 5% is known as excess reserves. So in actual, that bank has 15%, consisting of 10% required and 5% excess. Okay, so in the real world, most banks will keep excess reserves, all right, just in case something happens. All right, so this is a pictorial demonstration of reserves that are held by the commercial banks. Okay, imagine this whole lot is the deposits that's holding. Okay, the central bank will stipulate a portion of the deposit as required reserve. Okay, you see here, required reserves. The rest is open for the banks to lend out as loans. Now, the bank will decide whether do they want to lend out this entire lot as loans, or do they want to lend out only a portion. If they only want to lend a portion, that means another portion here would be the excess reserves. Okay, so the banks make a decision in how to deal with what to do with their deposits in total. But what is sure is that, and what they must do is, they must keep the required reserves over here, because that is the law that is mandated by the central bank. Okay, the excess they can lend out, they can keep as excess reserve, depending on what portion they want to keep as excess reserve, what portion they want to lend out, or do they want to lend out everything. Okay. Okay, so we have a simple exercise. The commercial bank, let's say, have $100 in deposit. The required reserve ratio is 10%. So what's the required reserve? 10% of 100 will be $10. So the commercial bank cannot lend out this $10, must keep it with them. Okay, so what's the maximum that can lend out? The remaining $90. Okay, now if this bank only lend out 70, so the remaining 20 become excess reserve. It's holding on just in case. Now, down the road, you may want to lend out this $20. It's their choice. Okay, but in this example, this $20 is being held as excess reserve that's not lent out. That is the bank's decision. All right. Of course, it's not required. What is only required is the $10 that's stipulated by the central bank. Okay. Now, how does this fractional reserve banking and commercial bank lending create money in the economy? Let's take a look. All right. Now, we must first examine the conditions in the banking system that's set by the central bank. Now, let's assume that the central bank has set a required reserve ratio, I call it RRR, at 10%. Okay, and we assume that banks do not keep excess reserve. That means they lend out whatever they can. Okay, so we assume that the banks, in this case, will lend out the remaining 90% of their deposits. Okay, so every time they deposit, they will keep 10% as stipulated by the central bank. They will lend out the rest. Okay, now let's begin the process with a new deposit of $100. Let's see what happens. Now let's assume that this $100 is deposited into Bank A. Okay, now as per our condition, Bank A must keep 10% of that as RRR, their required reserve ratio. They can lend out the excess 90. So let's assume that somebody took out the $90 as a new loan, okay, and deposit it in their own bank, in Bank B, okay, and Bank B now receive new deposit of $90, right? Now, Bank B will keep $9 as stipulated by the government, RRR 10%, and Bank B can lend out the excess $81. So let's assume that some customer will come and borrow this $81 from Bank B and deposit it into their account in Bank C. Now, Bank C therefore receive new deposits of $81, okay, and Bank C therefore must keep $8.10 because of the RRR of 10% and lend out the remaining $72.90, and the process will go on and on. Now you see what's happening here with this lending activity. Deposits are being created. Okay, deposits are being created from an initial new deposit of $100 that's held in Bank A because it was first deposited into Bank A. Okay, now Bank B holds new deposit of $90, and Bank C now holds new deposits of $81. Okay, and we calculate original 100 plus 90 plus 81, and when you imagine the process continuing from here, all right, more deposits will be created down the process. Okay, now you see that the amount of new deposits will be reduced as we move from one cycle to the next because of this RRR. Every time it goes into a new account, that has to be 10% has to be taken out, okay, to be kept as a required reserve. All right, before the remaining excess can be lent out. All right, so one account opening as deposit, the banks can lend out the remaining 90% as loan, and then that loan is opened as a new account for the new customer. All right, so some of you may have a hard time imagining this. So let's imagine that you are the customer that want to borrow money from Bank A. So you come to Bank A and Bank A says, oh, you want to borrow $90? I lend you $90. So where do I put the $90? So you borrow the $90 and then you take the $90 to your own bank account to open up as a deposit. Okay, so to Bank B, this $90 is a new deposit to them. And then they can use that money which you have borrowed from Bank A as new deposits to lend out further. So you see it goes on and on and on. Every time there's a new deposit. All right. Now you can understand a few things here. Money is not created by printing out money and then distributing out. It doesn't work like that. Money is created when commercial banks lend out money and then new deposit accounts are being created to host these loans. Yeah. So some of you could have borrowed money to pay for school fees and things like that. And banks always create accounts to put the loan amount into. All right. So that account is a deposit which the bank can lend out from again. Okay, and the cycle goes on and on and on. Okay, you can imagine this over a long period of time. Okay, so this is how money is created when commercial banks lend out. Therefore, by making loans, banks can create deposits and therefore increase the money supply. And you can see that something is being multiplied from an initial deposit, okay? The amount that's being created, the subsequent deposits that's being created accumulatively, all right? Something is being multiplied from the original deposit. We call this the money multiplier process. So you can see from a new deposit, okay, more deposit is created downstream. Okay, now some of you might be thinking, does money creation only work when you take out the loan and deposit it into another bank? No, we use another bank as an example so that it's clearer that way. Now, all this multiplying can take place within one bank itself, from account A to account B to account C within the same bank. It works the same way. Okay, we exaggerated the example of someone taking the loan and opening up a new account with another bank so that it's easier to perceive the multiplying of money that way. Okay, so as long as banks lend out, they can create new deposit, they can continue to lend out. Okay, of course, depending on how high or low the triple R is that they're going to keep as required reserve. Now, the process goes on and on and on. We cannot just follow the process in a pictorial way and then tabulate it manually. It's too troublesome, okay? We have a formula that we can directly calculate based on a certain new amount of deposit, how much money can be created by the system. Now, assuming that there's no leakages, what is that? We'll explain a little later. And that banks lend out everything that they can, legally can. Okay, that means they don't keep excess reserves secretly on the side. Huh? They lend out whatever they legally can. All right, we can use this formula, 1 over required reserve ratio. We can use it to calculate how many times that initial deposit can be multiplied. Okay, now the required reserve ratio that we use here, we must use it in ratio form. For example, 10% is 0.1, 20% is 0.2. Okay, that way we can work out a multiplying factor, a whole number. Now, to calculate new money created, we just take the money multiplier that we have calculated here and we times the initial excess reserves. Okay, that means how much the banking system can lend out in the first instance. Okay, let's have an example clearest that way. Now assume that the required reserve ratio, the triple R, is 20%. Okay, what happens when a person deposits $100 into a commercial bank? Now the value of the multiplier, okay, we use the formula 1 over required reserve ratio. Now the required reserve ratio is 20% here. Now remember, we must use ratio form, so we use 0.2. 1 over 0.2, we have 5 times. So it's telling us that there's a multiplying effect of 5 times whenever there's a new deposit that enters the system. So we use the 5 times what? The initial excess reserves. Okay, so the initial excess reserve is 80% of the $100. Why is it that we cannot multiply everything, the entire $100? That's because there's 20% that you cannot lend out. So that 20% didn't make it out of the door as loans. So you cannot calculate that 20%. Okay, only 80% left the bank as loans, which is used to multiply in the later process. Okay, so we take the initial excess reserve, how much you can lend out first time in full. All right, and you have a $400 new money created from an initial deposit of $100. Okay, now most of these $400 will be in the form of deposits held in the bank. All right. So when there's a lot of new deposits that's created, the commercial bank, maybe they'll call the currency house and say, hey, we have lots of accounts that's been created. We need some hard cash as backup. So the currency house will provide the commercial banks with the hard cash to back up the deposits, so that when customers come and withdraw money, they can withdraw in hard cash. Okay, so the actual hard cash is meant to support the created money in the form of accounts. Okay, creation of money is not just printing money and just distributing. It doesn't work that way, huh? Now, the central bank controls the required reserve ratio. Everybody must follow. All the banks must follow. Okay. Now, what's the relationship between the required reserve ratio and the multiplier? Let's take a look. Now, going by our formula of calculating the multiplier by using 1 over triple R, okay, if the required reserve ratio is 10%, okay, 0.1, you get a multiplier of 10. Okay, if I'm the central bank, I increase the required reserve ratio to 40%, 0.4. The multiplier 1 over 0.4 is 2.5 times only. Okay, now so you can see when the required reserve ratio becomes larger, that means the central bank says you must keep more and more cash with you. You cannot lend out so much. The multiplier effects become smaller and smaller. Now, this is what we have been saying in the first place. Money is created when commercial banks lend out. Okay, so the required reserve ratio is one way that the central bank, the government, controls the amount of money supply in the economy by controlling how much the commercial banks can lend out. Okay, by adjusting the ratio according to the situation. If they feel that the commercial bank should lend out more, they will reduce the ratio. Okay, maybe from 20% to 15% to 10%, and you can see that the multiplier will become bigger and bigger. Okay. Now, we talked about leakage earlier. Now, what is leakage? A leakage is when a borrower or customer withdraws money out of the banking system. That means they don't want to set up a deposit, or they set a deposit and then they withdraw the money away. All right. Now, when there's a withdrawal from the banking system, or the new customer do not want to open a new account, all right, this is what we call a leakage. All right. Now, a leakage can affect the total amount of new money created. Let's take a look at the process again. Over here. Now, if the leakage occurs here, somebody borrowed this $81 from bank B. So instead of opening a new account with another bank or with the same bank, this customer withdrew it as cash. Okay, they don't want to open up a new account. Now, if that's the case, all right, the creation of money will stop here. It will be terminated here. It will not carry on. Okay, this is what we call a leakage. When a customer don't open a new account or they withdraw the money away. All right, the commercial bank will not have that money to lend out to the next customer, and therefore the money creation will stop. Now, how bad does it affect the banking creation process? It depends on where the leakage occurs. If the leakage occurs very early in the picture, then almost very little new money will be created. If the leakage occurs very late into the lending process, then the overall total amount that we calculated that the system can create will not be very much affected. But you can imagine that every day there is a lot of lending process that's taking place. Okay, some will have leakages, some will not. Okay, and the central bank keep tab on the overall numbers to see whether the money that's created, all right, fits into a targeted money supply that they have. Okay, this is the end of our online lecture. This lesson provides a background for the next topic, which is monetary policy, which is the second policy tool that the government can use to resolve problems in the economy. All right. Do the tutorial and make sure you ask any questions that you have in your tutorial classes. See you next lesson.